From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, inflation cools. Core CPI takes its first step down in 6 months. And it's changing traders' expectations for further rate cuts this year from the Fed, sending Treasury yields sliding after a wild week of swings. But we begin with the big issue. Markets brace for Donald Trump's return to the White House.
The markets are really walking on pins and needles right now.
We're really beholden to policy here, which is not a great place from an investing standpoint.
There is still policies that could, kind of dent some economic growth. There is policies that could create volatility.
What is important really how they start with the tariffs. Is it high and then going lower, as I said, or is it step by step? So that's not quite clear. I think
deregulation side, that's the positive. The wild card is going to be the headlines around tariffs.
We think the risks are skewed towards more inflationary policies.
I don't know where they're going to go with this. I don't think a lot of people do.
What's really affecting the 10-year portion of the curve is supply, the concern about Treasury supply.
We're going into uncharted territory in terms of how much we're trying to borrow.
My suspicion is that the markets will continue to be quite volatile.
Now, if you take a look at where bond buyers have been stepping into the market, the gains are really led by the belly of the curve, and that is extending the two-day richening of the 2s, 5s, 30s curve to the biggest since July of 2023, if you could take a look at it. And it's interesting because that is like the BlackRock trade in a nutshell here, buying the belly of the curve and getting a little bit more uncomfortable once you extend out on the curve, which brings me to the term premium. If you could flip up the board here, we can see here that one of the biggest reasons you have seen a more expensive tail end of the curve here, yields much higher, is the term premium for the 10-year is really at the highest levels since 2015. A lot of this has to do with the cost that investors are demanding due to all of that uncertainty for extending a duration when it comes to treasuries, which creates a conundrum for incoming Treasury Secretary Scott Bessent as well, who's going to have to figure out how to issue at longer ends of the maturity wall here. Now, also speaking of policy, former Fed Chair Rich Clarida, he had said the Fed and the economy will need to remain flexible to rising yields.
Putting policy uncertainty in the context of where the economy is, I think, where the markets need to be. Bond yields can go up not just because of budgets, because of strong growth and optimism about productivity. So the Fed will have to do some signal extraction. But I think importantly, if yields sell off because Washington's running an irresponsible fiscal policy, then that's part of the way the economy needs to adjust.
Joining us now, Padhraic Garvey of ING Group and Sonal Desai of Franklin Templeton. Sonal, if you think about that longer end of the yield curve, there was an excitement here for a moment here because the 10-year did get a bid this week. We saw very promising economic data, but you did just see it at 4.8% really about a week ago. Do you think that this is sustainable, this leg lower in 10-year yields?
I think it all depends on the period. And realistically, I think that the 10-year actually does need to get closer to 5, if not higher than 5, depending on what we see from the incoming administration over the next 60, 90 days in terms of fiscal policy, in terms of all the other policies for which we have very little visibility right now. So we need to see how they're implemented and what gets implemented. So I think we're ranging over here. The speed with which we got to 480 was probably not sustainable, but a grind upwards towards that 5% level is entirely, I would say it's almost getting close to baseline for me.
You know, I also want to bring up this quote from Nomura this week because they have joined the likes of T. Rowe Price in calling for the 10-year hitting 6% this year. They wrote that they posit that the 10-year Treasury yields are still low in relation to two of its key drivers, consumer price inflation and the fiscal balance. There seems little scope to reduce the budget deficit of $2 trillion when combined with the refinancing of maturing debt could result in gross U.S. Treasury issuance of some $5 trillion here, or 17% of GDP. Padhraic, do you buy in to the 10-year when there's still that much uncertainty? And some investors saying 6% is possible.
So first of all, on the very near term, I'm a bit of a buyer. I'm a tactical buyer because we've had this huge move to the upside. We had some half-decent PPI, CPI numbers this week, so I'm okay with the 10-year yield testing down. My issue is that, you know, we can throw out numbers like 6%, but I've got to imagine in my mind what's neutral. You know, where's a fair value 10-year Treasury yield? And my go-to is around 4.5%. So given that, I don't think we can get below 4.5 too far. I mean, it's at or about that level now, 460. But once I see it hitting 4.5, it's kind of neutral to me. And the next move then, I don't disagree, is towards 5%.
You know, Sonal, if you think about what we heard this week from Federal Reserve Governor Christopher Waller, this idea that you can see the Fed lowering rates again in the first half of this year, while you still have market pricing pushing rate cuts out to really July. What do you think is possible this year in terms of rate cuts if you believe that perhaps neutral is higher?
I think neutral is higher. I think the Fed has been incredibly imprudent, giving away 100 basis points of a very small gift that it had in terms of rate cuts, given where the economy is. And therefore, I actually would agree with the market here. I think there's an extended pause, if not an end to this rate cutting cycle. And I tend to think that, you know, I heard what you said about what Nomura had said. What's changed? We've had $2 trillion deficits for 4 years. We've been calling for this for a while now. So we've had $2 trillion deficits, we've had extremely high inflation, and really nothing has changed. So that call for 6% seems to be, I would say, once we've seen what this administration actually does, yeah, sure, we might get to 6%, and that might be reasonable. But otherwise, if I look at the neutral rate at the short end, I'm looking at around 4. And therefore, if I look at fair value, going back to the last question, fair value for that 10 years, I put in a term premium. I put in term premium of something like 75 basis points to 100 basis points. And once again, I get towards 5. However, if inflation remains sticky or it even goes up, and we have those supply issues coming out of that fiscal policy that gets put into place, we could easily go above 5. I just think it's too early to say.
You know, the world is really on tenterhooks to figure out what the new policy will be from the new administration. Inauguration just days away now on Monday. What do you believe, Padhraic, is possible in terms of any potential inflationary forces from some of the policies that the president-elect has been discussing?
Yeah, the obvious ones are the tariff risk. And the original idea was 10% tariffs on everything. And I mean, if that was to happen, you'd have to brace for an economy-wide price rise of 0.5%. That's a rise in prices. Whether that's inflationary or not is a whole different story. But my issue at the moment is that if I look at the US economy, it's a 3% inflation economy. So the tariff threat puts upward pressure on that. The other big issue is the tax cutting agenda, together with the removal of immigrants. All of this is inflationary. So it's very hard to imagine a disinflationary narrative given that combination, which is why, you know, structurally still bearish on treasuries.
What do you think, Sonal, the new administration will mean? Has a lot of this risk been priced in, especially if you're of the camp that some of the tariff policies in particular will not or may not be as strong as what was initially posed during the campaign?
I agree with Padhraic. I'm sorry if I said your name wrong, but I would fully agree that, you know, you could have the tariffs in place, and we've estimated as well 0.4 to 0.5%. Tariffs are a change in relative prices. They're not, to me, that is not the determining factor for inflation. I'm really looking at fiscal because it has been fiscal, which has been at the heart of what we've seen over the last 4 years. Yes, there were supply shocks, but the fact we moved from those 9% levels to the 4% levels as supply shocks went away. And we have been kind of stagnant at around 3.5% now for the better part of months. For the latter half of last year, we haven't seen major progress on disinflation. And to me, this just means that inflation remains, inflationary pressures are stagnant, and if you get any upward pressure coming from expansionary fiscal, which fuels consumer demand, they're going to take off again. And that, once again, to me means the Fed can't do as much as it would like to do, as soon as it would like to do it, until we get more clarity on what's going to happen with this administration.
Padhraic, is this a wait and see moment? And if it is, what are you waiting for to put on any real conviction trades here? What is the best trade into this year that you believe will be the story of 2025?
So the trade is still short duration and positioning for the 10-year Treasury yield to rise. I do see buying of duration right now. The latest data is showing us that for the first 2 weeks of this year, the shorts we saw at the end of last year have been unwound, and now guys are coming back in and buying duration. So Treasury yields, that move to the upside has been aborted by this buying pressure short term. I'm looking for inflation to calm to a more sensible level. Remember, when the Fed cut in September, they had to wait for 3 or 4 months of decent inflation data before they could do that cutting. And the issue is, since then, we've moved back to where we were before that, when they couldn't cut. The market was discounting cuts, but they really couldn't cut because of the inflation dynamics. So I'm waiting for the inflation story to get into a better position over the course of the first half of next year, where we're not ruling out the possibility that the Fed does cut. We're still in this camp that the next move is more likely to be down than up. That's where we are.
But a lot of uncertainty still ahead. Padhraic, Garvey of ING and Sonal Desai of Franklin Templeton. We thank you both so very much. Have a great weekend. And up next, we're going to talk about the auction block, because it was a big week in the United States, because a big week. Big U.S. banks have wasted no time selling debt in high grade right after earnings. They have been flooding the issuance schedule. We're going to bring you details next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where issuance surged to close the week thanks to the big banks. Fresh off of earnings, JP Morgan, Citigroup, Wells Fargo, and Morgan Stanley, Bank of America as well, had big debt sales totaling more than $25 billion just for the banks. The deals pushing weekly overall issuance to more than $46 billion, surpassing dealers' estimates in already what was supposed to be a big year. Another notable sale for the week was Ken Griffin's Citadel. It sold $1 billion over 2 parts to fund a payout to its owners. The deal's book size, if you could believe it, topped $10 billion. And we end with U.S. leverage loans, as that area stays red hot to start 2025. The week's volume is around $50 billion, with Monday seeing the most launches on record. The bulk of activity continues to be mainly from repricings. Now, when it comes to credit, Morgan Stanley's Andrew Sheets lays out the drivers for current investor appetite.
This is a credit market that I think a lot of investors would describe as a good yield and kind of a bad spread. Yields are quite high, nominal, real, relative to history on the corporate indices. Spreads are low. And I think a lot of the buyers of credit at the moment are more yield driven.
Joining us now, Viktor Hjort, Global Head of Credit Strategy at BNP Paribas, and Tracy Chen, Portfolio Manager at Global Fixed Income at Brandywine Global. And the economic data this week was good. Tracy, when you think about what we saw in terms of CPI and even in terms of retail sales, for example, you did see retail a little lower than expected. You had kind of mixed data all in all, if you think about it, but inflation was promising. How do you take that all into account when you're making decisions right now?
Yeah, I think the data has been quite strong, and that shows you the resilience of the U.S. economy. And then if you look at the credit, either corporate credit or structured credit, the fundamental has been really strong, and the vibrancy of the U.S. economy give us more confidence to be constructive on the U.S. credit.
Viktor, how constructive are you at this moment? You have seen for the better part of a year now investors pushing spreads to essentially all-time tights. Is risk being priced into markets appropriately?
Definitely. We're very constructive, actually, but constructive in a sort of keep calm, carry on kind of way. One of the best things about the credit market right now is the fact that yields are high, and I really want to stress this, especially in a period right now where rates have been volatile. Higher yields are good for credit. Higher yields are good for credit because it helps attract demand to the asset class, and it also helps cap the worst excesses of supply. So it facilitates a better supply-demand balance. And that's one thing that I think suggests that actually volatility, in spite of all the politics, might not be so high this year. This might actually be a fairly unvolatile credit market. And that environment is, a carry environment. And that's exactly how we think we'll make returns.
Tracy, how do you think about this in terms of some of the higher for longer cross currents that we're seeing?
Yeah, I think Andrew Sheets has been characterized it very well. For the corporate credit market, the spread is bad, but the yield is good. Especially in this yield, the Treasury yield higher for longer environment, I think we are especially constructive on credit. And if you can manage the duration exposure, that's even better. So we really like higher yielding floaters or shorter duration corporate credit. And the fundamental has been strong. And one of the drivers behind the strong fundamental is a corporate has been terming out their maturity wall. So I think that has been really favorable driver for the solid fundamentals. And for household, it's similar reason, the lock-in of the low mortgage rate. So that's why the transmission mechanism from higher interest rate to the fundamental of the private sector is not strong. So we have a missing transmission mechanism. So that's why the U.S. economy is less sensitive to higher interest rate. And that's why probably the current higher rate is still not restrictive enough.
The entire economy, though, at the same time, has not been immune. I look back at analysis from S&P Global showing that U.S. corporate bankruptcies are actually at a 14-year high last year. Viktor, if that's also true at the same time when you're seeing fairly strong economic data across the board, how, as an investor, do you avoid those types of pitfalls in the credit markets?
Well, I think it is true that bankruptcies are high. The default rates, though, are probably not as high, and they have been peaking. I think the companies that are going bust right now are very small and mid-cap type of companies who are clearly suffering. The fact that the rate environment now is higher. When you look at the high yield default rate, it is trending down, and the loan default rate is also trending down, even though from much higher levels. I think avoiding the pitfalls is really avoiding sectors that have very front-loaded debt maturity walls, and also avoiding industries that are sort of inherently rate sensitive. We actually think that this is probably a pretty good environment to have a cyclical tilt to portfolios. There is a cyclical risk premium, which really shouldn't be there. And you have an incoming U.S. administration, which is pro-growth. So being in cyclical sector, I think, is a good way of positioning credit portfolios right now.
Tracy, how do you feel about this in terms of some of the asset classes you're in? You think about the CLO market, for example, and leveraged loans coming back with a vengeance to start the year. What does that spell for how the market will perform in the coming months?
Yeah, we are very constructive on CLO market. I think it has been the best performer for the past 1 year, 3 year, 5 year. The return is almost comparable to S&P equity market. So the strong performance is really due to the resilience of the market. CLO market has been through a global financial crisis, and it has been performing well. So I think floating rate, higher yielding instrument is the best spot to be.
What do you think, Viktor, of the CLO resurgence, if you will? Do you think that this is a place that's relatively safe because of the way it's been packaged, or does it pose some risks here, given the exuberance that's ahead?
So, I mean, the underlying loan fundamentals are, have been going through a default cycle. But a lot of the defaults, are restructurings, and therefore the recoveries are ultimately much higher than what you have in a typical bankruptcy situation. And therefore, I think the ultimate losses that we're experiencing are much lower than the default rates would sort of imply. So if you add on top of that the fact that the valuations are quite a bit more compelling than I'd say in the high yield space, loans and by extension CLOs looks like a great place to be. In 2025, and obviously also an asset class that tends to do pretty well if rates stay high.
Viktor Hjort of BNP Paribas and Tracy Chen of Brandywine Global. Thank you both for joining us today. Of course, a lot of implications across credit markets in this new yield environment. And still ahead, the final spread the week ahead. A new administration in Washington, global business leaders in Davos, and a busy week of earnings. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up on Monday, Inauguration Day in the United States. U.S. markets are closed also in honor of MLK Day. And the World Economic Forum begins in Davos. Tuesday, earnings from Netflix, D.R. Horton, and United. Wednesday, remarks from Christine Lagarde in Davos, plus more earnings from J&J and Discover. And Thursday, Donald Trump remarks from Davos and virtually, and earnings from Amex and Verizon. Friday, a rate decision from the BOJ and S&P Global PMIs. For my final thought, we're just looking at 30-year mortgage here over the last 6 months. The rates remain elevated at 7% despite rate cuts. We're going to keep an eye on that. But from New York, that does it from us. Same time, same place next week.